Good day. In this chapter, we are going to discuss the different types of covers available in marine cargo insurance in India. We will also briefly learn about insurance covers available internationally in marine cargo insurance. Basically, I am going to cover types of cover in India and definitely international covers. Firstly, we should understand the different types of cargo policies issued and the methods of, say for example, specific voyage policy is the for the particular transit. But there are a lot of problems in that. Like you want to send something on Saturday, Sunday, 26th January, 15th August, public holidays. It is not, it is very, very difficult. Also, each transit, the coverage, etc., has to be discussed. Then there is a open cover, open policy, sales turnover policy. Then there is a sales throughput policy. There are different methods of insuring. Then it is subject to certain clauses which we have already seen in section 4 and section 5. So there are different type of clauses A, B, C. There are different trade clauses, but they are the in particular from the contract point of view. But we have to see the methods in annual methods, sales tower methods, calculation of overall policies, etc., overall premium, etc. So all these things are to be considered considering various types of policies and methods of taking insurance is available in Indian market. Basically, this policy, cargo policy is issued for specific voyage, for specific transit only. That means for every consignment which I am sending it, dispatching it, I will have to have a different policies for that, and every time I have to have the similar type of the terms and conditions I have to discuss. The person who is importing very less or exporting very less, maybe his local dispatches are also very less. These type of people, they go for specific voyage policy. Say for example, foreign underwriters, when they issue policy to Indian merchants, those who are importing in India from foreign, the policy is issued is specific voyage policy. And then it is only for that particular voyage, from and to, everything has been described. So this covers, as it implies from the word, this is a specific transit only. This is on case-to-case basis, as many policies are taken for many dispatches. If I have daily 5 dispatches, I will have to take 5 policies from the insurance company. The cover is to be arranged before commencement of transit. That means when the transit has started, there is no way I can take the policy. Then it will become non-disclosure of material fact. It is a transit policy. It has to be taken. It should not so happen that I have taken my dispatches are there and there is an accident and there is a total loss of the consignment, and then I am going to insurance company and asking for insurance. This is fraud. This is non-disclosure of material fact. This is not permitted in insurance industry. There is no compulsion on part of insured to insure all the consignment. So insurance company can say, no, I have this particular risk, I feel it is heavy, I am not going to accept it. Or if they get a clue that already the consignment is having some problem, they will say, no, I am not going to take the insurance for this. So by mistake, incorrect insurance is taken, incorrect atom has been incorporated, and then there is no scope of corrections, because it is 2-3 days uh, uh, journey is there or something. There were many types of fraud in these type of policies. So for example, somebody will deposit a check on Friday evening with the, say, development people or the insurance company, and they will say that, okay, this is for, they will also take some sort of receipt from the insurance company or development officer that I have given a check. The check is not deposited because it is, say, Friday evening or Friday 5 o'clock, 6 o'clock. So everybody is aware of it that this will be deposited on Monday. What happens when the consignment reaches destination without any problem? The merchant and unscrupulous person from the insurance industry used to withdraw that check because it has reached. Now, this type of frauds are possible when it is a specific voyage policies are issued. And then the rates, condition, terms, etc. It is, of course, as per market condition, but decided on case-to-case basis. Whenever the cargo is sold, as per INCO terms FOB, the ocean voyage insurance will be taken by buyer. Because what is the terms of sale? Free on board. That means loading a vessel, it is the responsibility of sailor, and then the buyer will take insurance for the ocean transit, ocean voyage, what we call it. But then from my factory or the consignor's factory to FOB point, that is loading on board via CFS or via some port, you also require a insurance coverage for your cargo. So that is given in Indian market. The insurance company will give you FOB risk cover. What is FOB risk cover? It is covering 14 days or loading in a ship. That means if it remains for 15 days in the port, this policy will automatically lapse, provided I don't take any extension for my this FOB cover. Then the ocean voyage, it is the prerogative of buyer. He will take the risk, the policy for the ocean voyage. So the responsibility of sailor is to load the ship and take FOB cover, which is extension to inland policy. So for the exporter in India will take FOB cover, which is considered a 14 days extension to normal inland policy what has been issued. The FOB cover takes care of 14 days as already indicated in port or city of port. That means a consignment coming to JNPT remains in Bhiwandi for 14 days, then the policy has ceased. So they have to take extension for that. Thus, warehouse to loading on board with 14 days storage is FOB cover granted to sailor. So first thing, the foremost thing, you should understand for a export, there is also FAS term, there is free alongside ship. So whenever I'm loading a barges, then after loading the barge, the Indian policy will terminate. And then even many Indians, they will say that if it is a terms of sale FAS, our risk is not FOB, our risk will also remain free alongside ship or barge, whatever it is. The export incentives are also, it can be covered with a proper discussions with the insurance company. Now, what are the export incentives? See, once I'm exporting something, I will get some duty drawback or certain facilities because of I'm exporting certain goods. Similarly, IGST, CGST, all these things are waived when I'm having an invoice of export. I get that one back, or I can always avail a credit subsequently, and it will not be forming part of my export invoice. But suppose what happens when the consignment is totally lost? If it is not being exported and bills of ladings are not submitted to excise department, they will have the CGST, IGST or certain taxes. I will lose the export incentives, everything in that. So FOB risk is up to loading of a vessel. So there is a possibility, considering all these aspects, the FOB plus 10% are granted to take care of the loss of incentives to the insured because of accident. Because actual FOB value is supposed to be a conclusive value. It is on board, it takes care of clearing, forwarding, it takes care of transportation, it takes care of X works price and everything. But still, that 10% are permitted to take care of certain incentives which are hidden, which is not forming part of my uh, the commercial transaction as an invoice. It is also lost. That care can be taken by 10%. If the loss arises before shipment, insurance company will pay the loss proportionate to insurance. I say partial loss, partly loss, etc. will be consider the extent of loss, and then the assessment will tell you how much is the, we can quantify the loss. What is the quantification of? Now there are, as I said, that there are certain export incentives could be more than 10%. It could be different than the more than 10%. So in such things, it is every possibility that a person can take the incentive, export incentive policy, provides the cover will be something like this. It will be equivalent to FOB plus export incentives, what I'm going to lose if I'm not exporting. Maybe 10% are also added. There is another school of thought that FOB being a conclusive price on board, it takes care of all the expenses. It is not necessary to have any markup in addition to that, considering that it is a conclusive value. But you look at the incentives, you look at the certain CGST, etc., the credit which is not paid. Considering things, you should consider, you can discuss definitely all things to be, it can be discussed with the insured at the time of getting this FOB policy. This is a multi-transit policy, or what we call it multi-mode transportation. There will be land journey, there will be ocean journey, there will be journey by barges, there will be river navigation, there will be again transit by inland journey, maybe rail. So all these multi-mode transit policies are also issued. Whenever I am referring to some rating part anywhere in my lecture, whether it is this chapter or any other chapter, please try to understand this is from the particular book IC 67. It may not be in agreement, the industry may not agree with these rates, and they will consider the rating considering the risk, considering the insured who is there, what is the loss ratio, because underwriting earlier, yes, tariff was there, for each commodity tariff was there, but then the client changes, the losses can also change. There are particular type of drivers, 100% my experience factor suggests that whenever is a jacked up, the lorry is lying on left hand side, it is somewhere in muddy patch or rivulet or river, the cargo is totally lost, and it is always on left hand side, the vehicle is rolled over. So these type of losses are there, you should know. But then these are all the peculiarities. Earlier edible oil, which was actually sold at higher price, you will find such type of commodities which having buyer readily available, there can be a fraudulent losses, there can be a very skillful theft and pilferage. So whenever it comes to the ratings, the rating is having, it is also having a lot of bearings on your claim ratio. The party, there are some parties, I can say, of course, I would not like to take names of that parties, but they are very good. The management philosophy is good. They will never go for unnecessarily claims, etc. Maybe one or two employees, they want to show something to management, they will go for that. But then there are some employees, some of the clients, some of the exporters or importers, they have a different management philosophy. They feel that they have in commercial language, what we call the padta system. So if I am paying insurance premium of 100 rupees, so what is the actual benefits I am getting from that 100 rupees? So how much it is a cost to me? All these things are calculated. Now their approach could be different than any normal approach who's in functioning in good faith, an utmost good faith. So in multi-transit policy, the cargo comes in control of insured, the cover ceases. But then you have to see at the time of discussing, at the time of accepting risk, there was a case that the very big corporate, they have their own port. Now my ship is coming, I am unloading my cargo in my own port, and then from my own port it is going to my own factory. What is the destination? Factory. Port is not destination, but port it is mine. So if there is any damages in the port under my control, one should not say it is ceases. It has to be discussed. And see what happens, the recovery will be prejudiced. You will not get any recovery. Only thing you gave that in such cases, in your control when it is in the port is operated by you, and if the loss takes place, there is no recovery, so we will deduct certain percentage on account of delivery. But otherwise, standard rule is this, that whenever the cargo comes in possession of the insured, after unloading or after this thing, then the cargo has ceased. But then if it is my own ship, so there is a, for example, Reliance, they have their own ships. So if I am loading a cargo, that means it is in my possession, I will not give. This is not the correct approach. There are many people, Gujarat Ambuja is having their own ships. So storage is covered under fire policy and subsequent transit in marine policy after pre-dispatch survey. So if I am going to have storage more than 60 days, you see what is happening. This marine storage premium is less than the fire storage premium earlier. And that is the reason people used to maintain in the marine policy only. But the storage in marine is not automatic. It is a time given. If there is a financial constraint and I am not paying duty, so it remains in port, the people can look at it in a differently. So you have to see the fire policy for basic cover in the port. You can add theft, pilferage, earthquake, fire, flood, everything can be covered under that. The rainwater will not be covered under fire policy. So you have to see what are perils during storage in port area. That is that type of a contingent policy can be tailored for. It is not difficult. It can be tailored and given it to you. To avoid problems of multiple insurances, you see what happened, that there is a marine policy, there is a fire. So to avoid such type of multiple insurances, multi-transit policies are issued. The rating is something like this, that whatever the basic rate envisages, plus 50% for multi-transit, plus 0.01% for 1 week, part thereof for the purpose of storage, or 0.03% for 1 week or part thereof. This is the way how it is rated. This can change. This is not a holy, holy book. The commercial aspects are different. But then if somebody is asking you question in the examination, you have to reply. You have to adhere to this. This is not that popular with the Indian underwriters. I have not seen many insurance company is issuing this policy. They do give sales turnover, etc. But this policy covers goods against physical loss or damage while in total global chain supply in transit. During storage, even if it is company's inventory, in the process of manufacturing and subsequent storage, transportation, uh, all these things are covered in stock throughput policy. Policy is combining traditional marine policy, fire policy, and various allied policies in transit. Not in transit, even during manufacturing process. So cover is starting from the raw material in transit to final goods to the buyer's place. Everything is covered. It starts from the origin to the manufacturing to the final supply. Okay. Then there is no time limit for storage period, and cover is like a cradle to grave. Yeah, this is a very good word they have given. It is from cradle to grave. Everything, whatever activities are there, they are always covered under this stock throughput policy. Again, I am telling, these policies, this type of policies are not popular in Indian market. The insurable interests are divided as direct insurable interest, and there is a contingent insurable interest. That means I have my still financial uh, association with that particular commodity even after selling it. I have not received money for that. See, it is covering the seller's interest in various, there are different type of contingencies. Say for example, the consignee has not taken policy. The consignee refuses damaged goods and is unable to take delivery due to insolvency. So there are various, say for example, that in FOB cover, the insurance company can take a stand that my loss will start, my risk will attach when ship moves out as per Marine Insurance Act 1963 or 1906 UK. So, if she sinks at the time of loading only, then the seller's contingency policy will take care. One thing is to be sure in contingency policy, marine perils normally covered under the policy should be operative. Okay, so if there is a fraud from the consignee, it is not covered under the policy. There has to be marine peril which is operative. So in FOB and CNF terms of sale, insurance for ocean voyage is taken by a buyer. But he forgets, if vessel sinks and then there is no coverage for that, the buyer also refuses to pay to the sailor because there is no insurance and something like that. Then it is the seller's contingency policy will take care, because the titles of goods are changed. There is no direct insurable interest, but there is a contingent insurable interest which is covered under the policy. Seller's contingency policy will take care of that, but try to understand it has to be non-disclosed to the anybody. Only it is between insurance company and the insured. The buyer also should not know of that such policies, such terms and conditions are available. Now, if documents are rejected by buyer, the ownership and the risk is reverted back to the seller. So that time, again bringing it back or something. So there are certain credit policies for that. But then the contingency policy is taking care of the consignment if there are marine perils operating. So export credit guarantee insurance take care of only financial aspects. If somebody is rejecting and I have to bring it back, etc. So things are there. This is very popular policy with the corporate or the people having turnover over certain uh, crores. So this is like a open policy only, but without any obligation on part of insured to make periodic declaration. 15 days, monthly, 3 monthly, it is not required. No need to make any periodic declaration as full annual sales turnover is automatically covered in that. The basis of valuation is sales value. Maybe there is a markup of 10% on that or it is not there. Also, many times the IGST tax is not included in uh, the sales turnover policy, because IGST is again taken as a credit. In fact, it is not a sales, but it is a tax paid to government, and then subsequently credit is availed from the purchase inputs. So this can cover imports, it can cover export. It is not, it can cover, it is covering imports, exports, inland transit, intersale depots, transfers, incidental storage, and other clauses are like seller's interest clause only. This is very popular. You need not to make any declarations, monthly or 15-day declarations. This is also a advanced loss of profit insurance in marine, or also it is known as a delay in startup. This is also a popular for the projects, etc., because policy is covering loss of profits arising out of operations of insured peril, delay in the project giving rise to loss of profit, etc. The policy also covers delay in transit due to loss, damage to cargo, loss or mechanical breakdown, damage to carrying vessels, aircraft, or its machinery. Uh, there would be delay. There would be cargo is in damaged condition. The gestation for getting it back is also may delay my entire project. So there is no time limit anywhere. Cover available up to property reaching final site. The time excess days is 30 days provided in the policy. So this is also a very good policy for the project cargo. Basically, after specific voyage, the people started going for the open cover. Now, the open cover is basically a arrangement binding in honor, whereby insurer undertakes to insure all shipments declared by assured and which comes within the scope of open cover. So the every time I need not to discuss about the premium, etc. I may be telling in advance I'll be getting a open cover which is not a stamped document. So, but then I will be having the terms and condition of open cover. The premium will be agreed upon. So I have to, once I declared, the certificate is issued based on the terms and conditions agreed. So what are the features of open cover? This is not a policy. Again, what I'm trying to say, therefore this is not stamped. The premium payable on each declaration against which specific stamp certificate policy is issued covering each shipment. So you have to declare each shipment. It is something better than the you can say specific voyage policy. No sum insured, that means overall in open cover, you need not to give that, oh, it is 500 crore or 1000 crore, something like this. You have to declare, and then maybe you are paying the premium in advance, it is deducted, or at the time of getting certificate, you can be paying premium. Now, when we are referring to the advantages of an open cover, it is over a specific voyage policy. It is because initially it is specific voyage policy, then open cover, then open policy, sales turnover, sales throughout, throughput policy, delay in startup. This is the way how there is a, you can say, steps or rungs are there. So insured is not exposed to risk of shipment remaining uninsured due to oversight because of automatic and continuous agreement. The buying specific policies for each individual shipment is obtained, resulting in saving in administration cost. Premium rates are agreed at inception. This assists the insured to identify his cost of insurance right at the outset. So these are advantages over the specific voyage policy. So what are the salient conditions of open cover? The first thing is any policy as such, the important points are basis of valuation. So basis of valuation could be prime cost plus expenses. Normally it is written FOB plus 10% or CIF plus 10%, or you can say C&F plus 10%. So considering the terms of sale, that becomes the prime cost, and any expenses related to shipping can be added, or it is also convention to add certain percentage. 10% are popularly accepted on the basic terms of sale. The loss prior to declaration of or shipment, loss prior to declaration or shipment, either they should be giving held cover clause in that, or otherwise the intention is not to cover. The intention is not to cover the damage consignments, because this is a breach of utmost good faith. The cancellation after 30 days of notice. This can be the open cover can be cancelled once you give a notice of 30 days. There is a definitely under deck warranty that the cargo should be carried under deck, not over deck. You see, over deck cargo carriage is permitted when it is a custom of the trade. For example, containers. For example, the wool, ship's wool, which was always carried on above deck. I have also seen in my lifetime the onions are kept in the crate on deck, because it requires a lot of ventilation. So the crate gives you good ventilation, and onions are kept in there. The rule of construction of policy rule number 17 from Marine Insurance Act. The rule number 17 prohibits any above deck cargo, on deck cargo. Also animals, it is not allowed. And your personal property of the crew, etc. is also not considered as a cargo. So this under deck warranty is there. The right of insurer to respect records of the insured. There is a right of insurer to inspect records. Yes, if they feel that you are having some problem, you are not giving proper declaration, or there is some intention which they may suspect as a fraud. In one of the case, what I have noticed, that the consignment in a open policy, which was on say last month of that, when the period was over, there was a transformer which was very costly. This was damaged, and then they have put up a claim for the GST also. So I said GST is not part of your GST is not part of. You should be getting always credit. The insurance company felt that I should be checking whether the consigner is declaring in every. This was the open policy, so whether he is declaring the GST also in that. GST was not declared. Now, when the GST is not declared, there is a sufficient limits. But if GST is considered, or if the earlier claims are paid on the GST also, then the total limit was exhausted. So many times insurance company would feel that they want to have the. Then there is a declaration for each this thing shipment. Loss prior to declaration we have already discussed. So these are the basic features of the open cover. So what we have seen the specific void, then we have also seen the open cover. Now this is the open policies. This is also known as a floating policy. The clients having substantial dispatches and turnover can obtain continuous insurance cover. Cover ceases after period of 1 year or exhausting sum insured, which is whatever is occurring first. Sum insured can be increased if it is near to exhaustion, usually issued for inland transit within the country. So open policy is issued for inland transit, open cover is issued for overseas shipment, import, export, etc. It is very important. So annual policies are for 12 months. The period is 12 months. Issued to cover goods belonging to the assured or held in trust by the assured. Held in trust means, say something I have brought it for the purpose of repairing it. I am sending it back on my own account. So there are a lot of goods are held in trust. It has come for the processing at my on my account, and then the transit is under my account. It is not assignable, or it cannot be transferred. It is subject to appropriate inland transit, rail or road covers the clauses. See, it is subject to ICC A, B, C. So that will be recorded, the terms and condition of the policy covering different type of clauses, the warranties, the conditions, the do's and don'ts, what is the excess provided in the policy, what is basis of valuation, everything will be incorporated in this document. The sum insured represents maximum value of the goods at risk at any one time during policy period and remains constant if no claims. They will also provide, be it a open cover or be it a open policy or sales turnover policy, that what is going to be a per location limit. That means in my container freight station or one particular port, the value of the atoms concentration should not be say more than some crore rupees which is specified. In then per bottom limit, in the ship, I should not be importing or exporting the atoms which is spilling over certain value, that is the risk which can be accepted by the insurance company. So they are maintaining per location limit, per sending limit, per bottom limit. So all these limits are forming part of the annual policy or the open cover policy. There are various ways of looking at it. You see, this concept has come for bottom limit. In Yangtze River, Chinese used to keep their cargo, not every cargo in one boat, but they used to distribute cargo in different boats. So if one boat sinks, my loss is minimized. Based on this concept, the per bottom limit has come out. So this is basically issued for inland transit within the country. Sum insured represent as a maximum value cargo at risk. Then this is a special storage risk insurance. This is issued to supplier and consignor only. Okay. So anybody like port or someone else cannot purchase this policy. This special storage cover is granted on the goods in railway yards or carriers' premises, awaiting clearance by consignees on termination. 1 year corresponding open policy is issued in general. Sum insured is may be fixed by clients, but not less than 10% of the sum insured. Okay. So sum insured is fixed. Limits of liability fixed by the insured may be fixed by clients, but not more than 10% of the. That means that, say, in railway yard, my liability cannot be more than 10% of the sum insured, overall sum insured. So full payment is given as a premium at the inception without any installment. So there are no installments provided when it is a special storage risk insurance policies. You require at, say, port, there is a storage is required sometimes for export or for import. Maybe for export, you are waiting for the vessel. Vessel hasn't come. The vessel is expected to come in 10 days, 15 days. It is taking more time. There is a queue in port for coming alongside. So these type of policy will help the exporter and importers, and also for local transportation. Duty and increased value insurances. It is only basically in imported items. There is a custom duty, there is a basic duty, there is an additional duty, or you can say special duty on that. There is a IGST, and IGST is also levied. So now the duty structure has been simplified. It is in three parts: basic, then a 10% addition, and IGST. So this duty only for goods imported in India, the duty is paid. This is issued to a person whose name import is license is issued and endorsed, or the name of that importer will be incorporated in bill of entry what is filing. The scope and duration is identical like original policy. No duty cover can be granted after arrival of the vessel. So I have to take, you see, in open policy they will be taking plus duty, and whatever is the duty amount will be agreed upon, and they will be paying duty also on part of it. So in basis of valuation, they will say, for example, give CI plus 10% plus duty. But the duty, the 10% are not added on this duty portion. The duty you have to, every portion of duty has to be insured. The limit has to be provided in advance. In sales turnover policy, it is not an issue because automatically duty is forming part of sales, and considering all these things. But if it is there are certain rules about the duty remission also. So somebody is claiming a payment on duty loss, they have to see whether there was a possibility of getting remission or there is no possibility of getting remission. The custom duty cannot be subrogated. That means the insurance company cannot pay the claim and get rights of subrogation and fight with custom. Custom duty is not under subrogation. So you have to fight the consignee and consignor. They will have to see for the duty portion themselves. So what are the duty and increased value insurance and general regulations? You see, the total loss of whole or part of cargo prior to duty becoming payable, claims are paid considering actual duty paid or sum insured, whichever is less. Now, there are a lot of rules and regulations for the, say, for example, a liquid bulk I am importing and there is a shortage of, say, 1%, there is a shortage. So, considering 0.5% excess, there is a claim of 0.5%. Now, there are many times some people will prefer a claim for duty with the insurance company, but then the rules and the circulars and the court verdicts has said that if it is a liquid bulk, the duty is levied based on arrival quantity in the storage tank. So where you will come to know shortage? In arrival storage tank. So whatever is shortage, I need not to pay duty on that. So you cannot claim. So there cannot be claim for the duty on liquid bulk paid to custom because they will get remission on that. Similarly, if there is a loss prior to clearance, prior to, you can say, the appraisal or the inspection by uh, custom, and if there is a theft, pilferage or some damages are there, you can always get a duty remission. For damages, etc., there is a process of getting duty remission, but it is too long a process and it is very, very difficult to get because there has to be, after damages, revaluation of the product to be carried out, and the customs, they sincerely do not appreciate this one. Not that it cannot be done, it can be done, but it is a long, tedious process. The rate of interest, the rate of insurance is 75% of the CIF insurance, 10% are not added, and because duty portion is limited for, in a way, inland transit, the risk, the rating pattern is little different. The duty and increased value insurances, what is the general understanding and general regulations? Many times what happens, whenever I am importing an atom from some overseas country, the rates in Indian market are different or much more than the value at what I am purchasing. There is an increased value by reason of market value of the goods at destination on date of landing is more. So then I opt for the increased value insurance in these type of cases. Many times we are giving a markup of say CR plus 10%. Now this 10% takes care of local transportation, etc. Many times a consignment of sulfur, etc., or the perlite ore or certain consignments, they will be very less costly than considering the inland journey. So if my inland journey is more than 10% inland journey transport charges and also clearing, forwarding, etc., if it is much more than 10% of the CIF value, then I can tell insurance company that up to port you can have the CIF value, but in inland journey I want CIF plus 20% because the expenses are more and you'll have to give the cost sheet. This will be agreed upon. That should not be any problem in that. So CIF value plus duty plus increased value. We also said that there is a chances of increased value uh, uh, should be more than the market value of the goods at destination. The claim payable will be proportionate to market value. Say for example, if there is a total loss of this consignment, and I have considered, I have seen what I have seen, CIF value plus duty plus increased value insurance, whatever they have taken. In case this particular value is more than really a material available in the market, then I will pay only the market price what is available. So what we call the concept in marine insurance is sound market value. So it is. So I'll give you example. For example, if I have taken increased value, say for example steel. I know that when the steel I'm importing, the prices are rising and it is more. So I have taken the insurance CIA plus duty plus increased value, which is coming to say 120 rupees per kilo. But when there is a total loss of that consignment, of course we are going for the salvage value. I realize that the market value of this steel, if I purchase a coil in Indian market, it is available only at 120 rupees. So in that case, he cannot make a profit out of loss. The insurance company has never exercised the option of purchasing one coil and give it to party. But then to have the true indemnification, the market value is considered for the payment of losses when it is put up in this increased value clause. The CIF value plus duty plus increased value should be less than the market value of the goods at destination at the time of claim payable will be as per policy value only or in the proportion. This is a basically package policy under duty exemption scheme. This is basically a package policy issued to exporter who are granted an advanced license for import of import duty free specified in the duty exemption scheme. This is incorporated in chapter 7 of the export and import policy of the government for imports of duty-free raw material, parts, spares, which is required by the purpose of export production. There is no what you call that. It is a 100% export-oriented unit. On import, everything is duty-free. But if I cannot complete my commitment of duty, commitment of export, then whatever I have imported duty-free, I have to pay duty on that. So this is the certain features. So their policy is going hand to hand with the rules and regulations of the customs. So this is very important to understand the implications and who can take the policy. This package policy is subject to satisfactory pre-dispatch survey from the port or airport. The inland transit, this is the package policy under duty exemption scheme, have 3 different sections. Inland transit after clearance from port or inland transit. The sum insured is market value of the raw material imported. You see, try to understand the concept of market value. It is a sound market value of the cargo. So it will take care of the actual invoice value, then the freight, then the duty paid on that, and also the local transport charges, which includes loading, unloading, and labor charges, etc. So once you add everything, it becomes a market value. So this is the market value of raw material. This is the sum insured. The storage and processing risk covered in processing house, covered under license. The sum insured is fixed by insured, but not less than 20% of the market value of entire finished goods. And then the outward transit of finished goods for export. The sum insured is market value of the finished goods. It cannot exceed that. The scope of cover under this package policy, it is for inward and outward transit. That is from the port or airport. It is inland transit clauses A, rail and road risk, and ICC air as applicable for inland transportation. For storage and processing, the risks covered are fire, lightning, explosion, implosion, Reutz, strike, malicious damage, terrorism, impact of rail and road vehicle, aircraft or articles dropped therefrom, but excluding damage by pressure wave. So any explosion, pressure wave is damaging, it is not covered under the policy. The way there is a seller's contingency policy, similarly there is a buyer's contingency policy. So buyer's contingency, as we have, first thing we should know, what was the buyer's contingent interest. So what is buyer's contingency? There is every possibility he has paid as per LC. The titles of goods are changed when the ship is loaded. So there are in this particular consignment, the buyer's interest is also contingent interest is there. It is recognized and the policy is issued considering buyer's contingent interest. Now this existence of insurance, it is not to be disclosed to seller or any other parties. So there is every possibility that the seller has taken the policy, but that policy is not honoring. So under my buyer's contingency policy, if the marine perils were operative, I can put up a claim with the insurance company under buyer's contingency policy by showing all correspondence exchange with the seller. So the immediate notice of cover becoming effective, subrogation against seller and third parties are possible. See, it is like this, that the policy is prerogative. He has taken money under the contract, CIF. So he has taken a money for insurance also from you, but then he has not, maybe he has not taken a policy or some problem is there. And when the loss is there, if at all there is a insurance company paying under buyer's this thing contingency, they will take a letter of subrogation for claiming against the contract with the seller and also with the carrier. Normally, what all the seller's obligation is to arrange insurance only ICC terms only. You see, ICC terms are the basic what you call the basic perils which are covered. It is not covering the particular average attributable to various other things. So it is only in a way total loss of the consignment. In a way, I'm telling. So whenever the insurance policy is on ICC terms only, in such case buyers can take a ICC A or wider than arranged by seller. That policy is possible. You can always tell that I want ICC. ICC is a in a way all risk policy which is covering different type of losses. Of course, it is falling. If it is falling in exclusion, insurance company would not pay. But you can take a all this policy and come out of this named peril policy, which is a basic policy. If the loss is attributed to ICC perils, then the loss is recovered from the seller's policy. It's very simple. It is named, like fire, explosion, and then overturning of vessel, etc. So sea perils are also named, and you can always you can always put up a claim under the sea policy with the seller. Any other perils are operative, then you can put up a claim with the your policy taken in, say, Indian market. So there are certain international covers are also available. So for example, freight contingency insurance. So when the freight is to pay basis on arrival, invoice will not be showing what is the freight, etc. And then either it is paid by the buyer, or after arrival he has to pay it to the freight owner, the vessel owner. So the invoice will not contain freight charges, and accordingly it is not insured with cargo value. Because normally when you are taking a policy, when something is coming on only FOB value, it is always better to consider freight and also consider the insurance. How customs looks at it? If any FOB policy, FOB terms of sale is there, and if the freight and the insurance is not declared by the buyer in India, the customs is taking 20% as a freight and 1.125% as a insurance. So this is the way how customs looks at it. So you can always some cargo like timber freight is payable when it is earned on arrival. So there you can have this freight contingency insurance. If at all there are losses, you will be paying for the freight can also be claimed from the insurance. Increased value insurance policies taken for commodity trade for sales on high sea sale basis. You see, when certain commodities sold on high sea sale basis, the invoice value of purchase will be different, and bill of entry price of invoice will be having that addition of the amount what you are paying it. On high sea sale also, I think there is no IGST, etc. because it is not in Indian waters, it is on high sea sales. But then, for example, if you are a buyer and you want to, normally the policy taken by the seller or the original buyer up to that port continues. But it is with a less value. So moment you know that there is a what you call high sea sale, and the ultimate consignee should inform the high sea seller or the original consignee to inform insurance company, get his name endorsed right up to the destination port, and also inform that the value is now increased to X price, and then pay the premium on that. So, if at all there is a total loss and the losses are there, you have a valid cover up to port. Subsequently, this may not be covered. But if this original policy is, say, from port of loading to the final destination in India, if you want to continue with this, the bill of entry is filed by someone else. The insurable interest is now totally changed. So you have to inform insurance company, these are the circumstances, I would like to continue, or the buyer can take the separate policy for inland transportation. This is very important because the question will come that what is the insurable interest of the seller having sold it on the high C sale basis. So how his policy would continue when the bill of entry is filed by someone else. So this has to be discussed. There is nothing seriously wrong. You can always discuss, inform insurance company. If they give endorsement, it is okay. Otherwise, it is always preferable to pay additional premium for that inland journey what you are covering. So during high C sales and successive sale, prices increase. So purchaser takes the policy for increased value. So the prices are different when there are various other reasons also that the sale price I have purchased at X rate, but then the Indian market prices are quite high, and if the loss is there, my profit margin is say 25%, and which is not insured. So that can be discussed with the insurance company, and we already discussed about this increased value. If the loss is there, then it will be considered, it will be compared with the CIF plus 10% plus duty plus increased value, and compared with the market value of the items at the place of loss, and whatever is less will be considered for the settlement of claim. Thank you very much. It is the end of my lecture on chapter 6, types of different covers for the cargo which is available in Indian market. So we have seen the types of cover in India. We have also seen a couple of international covers. But then you try to understand that everything is into 4 or 5 sections only. One is specific voyage policy. Then there is open cover. Then there is open policy. Then there is a sales turnover policy. And there is a stock throughput policy. And then there is a buyer's contingency insurance. There is a seller's contingency insurance. Because the insurable interest could be a direct insurable interest or contingent interest. And for everything, policies are available. So you should know about this. Thank you very much.